Good afternoon, everyone. How are you doing this afternoon? I'd like to also welcome those who are watching or listening via webinar. We are recording this live and broadcasting this live, so anyone can watch it throughout South Africa from their PC or their computer at home as well. My name is Ralph Spears, and today I'm going to be doing a presentation on investing on the stock exchange. We've got Mark Wheatman, who's from Vunani Private Clients, and he is the CEO there that's going to be talking about from a broker's perspective and explaining to you as Stokvel or investment clubs how you guys can get involved and start investing on the stock market. So my presentation, I'll be doing the presentation, after which Mark will come and take over. We will be taking questions once I'm finished with the presentation. Otherwise, at the end of both presentations, you can ask us as many questions as you like. Those who are watching by webinar, please feel free to type in your questions and we will answer them at the end of the presentation. So in the top right-hand corner, you can click on chat or hand in the top right-hand corner and you can actually type in your questions. Okay, great. Let me get started. A little bit about myself. I've been working here since 2009 in the educational section of the JSE. And before that, I was working at the University of Fort Hare in East London. I'm from the Eastern Cape. And I am an investor myself. I am passionate about the stock market, and I love looking at new strategies on how to actually find the best way to grow your money. So today, I'm going to be doing a presentation, just an overall of how the stock market works. I'm not giving any advice, so this disclaimer that I'm showing you here, I'm not allowed to give you any advice. No one at the Johannesburg Stock Exchange can give advice, okay? But Mark and his team, they are able to give advice to you, and that's where you need to speak to the stockbroker to try and help you select the shares and get advice on how to go about it. So if I show you any of the shares on here that might look impressive now, please don't take that as advice. So what is the JSE? Well, it's companies raise capital to finance their business. So they come to the JSE and they raise capital by selling their shares to the public, and in turn they get money that they then can go and use to expand their business. It's also a marketplace where shares and other financial products are bought and sold. If you own a share, you own part of a company. Someone who owns one or more shares is called a shareholder. Okay? So if you own any of the shares listed on the JSE, you're a shareholder. So you can be a shareholder of MTN, Sasol, you can be a shareholder of FMB. So you're owning part of that company, but it will probably be very small unless you've got a huge chunk of money that you put in there. Otherwise, you're just one of the many small shareholders in that company. Shares are sometimes referred to as stocks, equity, or securities. So don't get confused when we talk about equity or securities or stocks, one in the same thing. You'll see here, this is the old trading platform, those pictures over there, and that is no longer taking place at the JSE. It stopped in 1996. We no longer have the trading floor, so everything is done electronic, and so it's all done via the PC. So you won't see any brokers here in the JSE building during the week actually buying and selling. Many people come here to look for that, but unfortunately it closed many years ago. So there are two ways to make money investing in shares, and I'd like to explain them to you. You can share in the capital growth of a stock, as well as share in the profits, dividends, payments. So companies, they would make a certain amount of money during the year, and if they decide to share some of their profits, they'll issue out a dividend, and you would receive a certain amount for every share that you hold. Okay, and I'm going to show you an example of that. There's no guarantee that any company will pay a dividend, so you can't expect it every single year. Some companies declare it, others don't. It all depends on how well they've done for this year. Okay, so I'm taking an example. I've taken an example of ShopRite. ShopRite capital growth. I'm just showing you this. We take an example, and most of my slides have got 10,000 Rand examples here. You put 10,000 Rand in, you're buying it at 10 years ago. This is just obviously history. You buy it at 9 Rand 70 10 years ago, 30th of April 2004. So if you put 10,000 Rand in ShopRite, okay, you go 10,000 divided by 9 Rand 70, which is the share price, would give you 1,030 shares. Okay? Obviously, I have not taken brokerage into account. You need to still pay the broker to actually make this transaction. But so 10,000 divided by 9 Rand 70, which is the share price, and then if you went and sold it now, 30th of April 2014, you would be selling it at 175 Rand and 69 cents. Okay? So, what is your profit? Well, 175 Rand and 69 cents now minus the 9 Rand 60 you paid at the start gives you 165 Rand and 99 cents each for each share that you owned. How many shares did we own? 1,030. So you go 165 Rand times 1,030 shares will give you a growth from your 10,000 Rand of 171,123 Rand, excluding brokerage and excluding tax. But that is pretty impressive, right? Okay, but that's not all. Because remember, when you're holding a share, and in this, if you invest in long-term here, this is a long-term investment, you also get dividends if they declare it. And in this case, ShopRite has got 1,030 shares. In total, if you add up all the dividends, and I've added it up for the past 10 years, you would have received 17 Rand and 39 cents. So I took each dividend that you get paid each year, added it up whenever they declared it, and it came to 17 Rand and 39 cents. That gives you 1,030 shares. Remember, that's the shares you owned over here, times by the total number of dividend was 17 Rand and 39 cents. And you would have a dividend total of 17,911 Rand on top of the profit that you made from when you bought it and sold it later 10 years. So it'd give you a total of 189,034 Rand. Okay? Not every share is going to perform like this, but this is an example. Moving along, this is just ShopRite over 10 years, just showing you the chart again, the same thing, just now in picture form, and these are the amounts that came along. These are the dividends. Everything is in cents. So you got 19 cents for every share you own. That's the dividend they paid. Right now, the last dividend they paid was 112 cents, which is 1 Rand 12. Yeah, 1 Rand 12 cents. Okay? So you need a stockbroker to invest in the stock market, what I've told you. So you as the buyer would go to a stockbroker, and here Vunani is with us today. You can go via Vunani and actually open an account, and then you'll be able to trade on the Johannesburg Stock Exchange. So when a company comes to list on the exchange, they want to come and actually, one of the big companies, they'd like to come and list their company here. They would either go to the main board or the alternative exchange. And what the JSE goes and does is all the companies are then divided into different groups. Now, I'm sure that you have heard of the all-share index. Every night you watch news just before Generations, 8 o'clock, you'll see the market indicators, right? And they say the all-share index, probably on Friday, I think Friday it did hit 50,000 again, I'm not quite sure, but they'll say it hit 50,000 points, okay? But what you got to see, they normally say it went up by 300 points or 400 points. But you take the 400 points or the 500 points, whatever it went up by, divided by the 50,000 will give you the percentage it moved. But what is the all-share index? The all-share index is the top 160 companies on the JSE. It's the biggest companies on the JSE. That's why it matters. And, you know, it's like, for example, we've got 384 companies on the Johannesburg Stock Exchange, but these indices are then compared to, like the all-share index is compared to the Dow Jones. You guys heard of the Dow Jones before? That's the top 30 biggest companies in America. You've got the FTSE 100, which is the top 100 companies on the London Stock Exchange. So every day, the indices, the all-share index either went up or down, and we compare it with other international markets just to see how we're doing. Now, if you look over here, underneath the all-share, we've got the big top 40 companies, then mid-cap and small-cap, and I'll show you some examples of that. This is the all-share index, how it's moved up over the years, and now hitting 50,000. So if you get over here, the top 40 companies, if we look at some of them, I'm sure you guys can recognize most of these brands, right? These are the top 40 companies, with the biggest being British American Tobacco and the second biggest being SAB Miller. Okay? And this is the market capitalization, how big they are. And you have British American Tobacco, 1.2 trillion rands worth. SAB Miller, about 900 billion rands worth, and you can see all the top 40 companies all the way down to Mondi at the end there, okay? If we had a look at the mid-cap companies, these are some of the mid-cap companies. So we've got the top 40, then you've got the next 60 companies. These are the mid-cap companies. I'm sure, again, these brands you're very familiar with, right? You've got the small-cap companies. And here's some of the brands, including the JSE. Now that's surprising, huh? The JSE is a listed company on the exchange. So you can own some of this company on the exchange. We listed in 2006 at 20 Rand a share. Today it's trading at around 100 Rand a share. Okay? So if you think you like the Johannesburg Stock Exchange, you can actually go and buy some of the JSE shares. Okay, and these are some of the other small cap companies here. If you look at the all-share index, okay, which I've told you is the top 160 companies, in the last 1 year, okay, last 1 year it's moved up 18%. If you look at the mid-cap companies, it's moved up 13%. Small cap, 22%. Top 40, 18%. Resources, 12%. Industrials, 21%. Financials, 21%. Gold mining, it's minus 11.99. And Altex, 24.32. Okay? Now, that's just to show you a gauge as to how well the different groups of shares are doing, or different sectors. In this case, some are resource industrials. But now you can actually go and invest in some of these indices, okay? Let me explain it to you like this. Has anyone heard of exchange-traded funds? You can go and buy this basket of shares, which basically, yeah, you can explain it. ETF is what it tracks an index. So if you've got the top 40, you can't buy the top 40 companies from the JSE. You can't buy it from the index, but you can go and buy a product that tracks and follows the same direction as whatever performance the top 40 gives. So you've got like Satrix 40. You can go buy the Satrix 40. If you wanted to track, for example, you could go and track mid-cap. There's a RMB mid-cap, and you would get that performance a little bit different, maybe with the cost, but otherwise 13% if you had actually gone and bought the mid-cap. If you had bought the Satrix 40 in this case, roughly 18% you would have received. So you can actually go and buy these shares, okay, that track the index. They're also listed on the exchange, and it's a nice product if you don't want to try and guess. Well, you would be guessing when you're starting, but if you don't know which share to buy, buying a group, you're diversifying, you are lessening your risk in the fact that you got 40 shares in this example. If you put the Satrix 40, and if 10 of them go down, but the other 30 go up, it's balancing out. Okay. So you can go and, for example, in this case, get those 40 companies and buy it through a product like Satrix 40. Now, here's some of the, I just took a few of the ETFs for the past 5 years. If you put 10,000 Rand in and you bought any of these, you can see Satrix 40, it should be just under 24,000, about 24,000 Rand. So you put 10,000 5 years ago. Today your portfolio would be 24,000. So you go 10,000 minus 24,000, or 24,000 minus 10,000 would give you a profit of 14,000 if you had sold. The industrial one, which is the green one, would have given you your portfolio would be now worth 35,000. So 35,000 minus your 10,000. You would have 25,000 Rand in 5 years by investing in the Satrix industrial product there. And the gold one here hasn't performed too well. It's now a 17,000, that black line, about 17,000 there. The worst performing out of this group is the Satrix Resi, which is the resource companies. And we all know that the mining companies have been battling. However, of recent, some of the companies have now started performing quite well this year, but in the past number of years, it's had some bad performance. So if you go look here in your brochure, you can actually look at all the different ETFs. This green brochure that we gave you, I've got the list of all the names of the different ETFs that you can actually go and buy. And it just gives you a brief summary, that description of that. And for those that are listening via webinar, you are welcome to email me and ask me for that brochure, and I can always just forward to you via email by sending an email to clubs@jsc.co.za. Okay, so here I'm just showing you the top 40 return of 2013. These are the different companies, and you can see the JSE uses 3-letter codes for each company. And here the first one, from your left-hand side, Naspers, just under 100% return in 1 year. Okay? These are the top 40 biggest companies on the exchange. This is their performance. If we're to go look at ShopRite, where's ShopRite? SHP. ShopRite, minus 20% last year. Okay? If you're to go look at Goldfields, minus 65, maybe 70% negative last year. So can you see there's not always easy to get to be able to select the right share, because here's the top 40, but some were going down quite badly last year and others were doing pretty well. But if you bought the top 40, the green line over there, you would have actually got the 18% roughly return for the year by buying the actual top 40 ETF. The green line. Okay. If you had a look at the top 40 from 2000 here, the beginning of this year until Thursday, Anglo Gold, Ashanti, 30% up. Okay, so you can see gold mining company done pretty well here. Sasol, about 18%. If you had a look at Old Mutual, just under 10%. But on the other side, you've got Combine, or about 25% negative, and I think IMP's Impala Platinum just over negative 10%, and again ShopRite is doing a negative right now over there as well. So if you had bought the top 40, you would have probably about 8% so far this year. That's the ETF. Looking at some of the mid-cap companies, okay, this is, can somebody help me, Mark? SGL, that's Goldfields' what's the company's name? Sibanye. Sibanye, sorry about that. Sibanye, 110% this year alone. Okay, but on the other side, you've got 38% negative, and that is African Bank, ABL. Okay, so those are two extremes, but you can see a lot of the companies doing nicely there, just over 20%, some of them over 10%. So yeah, it depends on which company you buy, you know. But It's for you to help get the stockbroker, in this case here we've got Vunani today, for them to try and help you find these gems amongst the mid-cap companies. Okay? So that's what the brokers are there to do, is try and help you get to be on the right side and get the companies that are doing pretty well. I just made up this chart here of all the individual stocks that have been listed since 2003 and are still listed until 2013, of which there's 180 companies. And out of them, if you look at the percentage-wise, 87 of them have done 300% or better. So out of the 180, 83 of them have done 300% or better in 10 years. If you had to take it from 0 all the way to 300% or better, it's around about 150 of the companies, 150 of the 180 have performed, have made a profit. Only 30 of them are negative. Okay? But you must remember, companies could have delisted. Companies could have actually failed and delisted, and it's not showing here because I'm only taking the listed companies. Okay? Now, I'm just going to show you a few slides just on different performances. And here you've got Sasol. If you put 10,000 Rand in 10 years ago, today your portfolio would have 60,000 Rand. Okay? Not bad. How many of you guys, have any of you bought the Sasol Mzalo shares? I think they are sitting at around about 470 Rand, somewhere around there. So you bought them for 360, they're now 470 Rand, and hopefully they'll eventually reach the price of Sasol's around about how much? 600 Rand, somewhere around there? Where is it? 600? 600? 600, huh? Yeah. Okay, so if you look over here, you would have got 59,650 10 years from in the past 10 years if you hold the Sasol share. Woolworths, you would have got 121. Your portfolio would be worth 121,000 Rand. That's Woolworths. I'm only showing you mainly the top 40 companies. Anglo Gold, I have to show you both sides of the coin. Can't always show you the rosy picture. This is obviously Anglo Gold Ashanti, a big company, a mining company. You would have put 10,000 Rand in, and today your amount would be worth 8,591 Rand. That's reality, and that's the stock market for you. Okay? So there's no guarantee in the stock market. You're buying the shares at a price, and you buy them 10 years ago. If you bought them at 10 Rand, and today they're worth 8 Rand, 10 years later, you have lost 2 Rand. That's reality, okay? There's no guarantee. We're not a bank where you earn interest, okay? You're buying a share at a certain price, and if it performs well, you're going to do well. If it doesn't, you can lose money like this. In this case, you've lost quite a bit of money because it's obviously the devaluing of 10,000 Rand in 10 years. Yeah, but then you must remember that you still get dividends. If the company paid dividends, and it probably would have covered a few of the costs. Let's go look onto Naspers. You guys know Naspers that owns DStv. Here, 220,000 Rand in 10 years. Not bad. Aspen, 254,000 Rand in 10 years. And if you bought Capitec 10 years ago, instead of putting your money in Capitec and saving in the bank, and you actually went and bought the bank, okay, became a shareholder, you would have 433,000 Rand portfolio worth. Your portfolio would be worth today 433,000 Rand if you had gone and put 10,000 Rand down and bought Capitec Bank shares. But an interesting thing, and I thought I'd show you as well, this was 10 years ago, right, 2004. But Capitec listed in 2002. So if you had bought when they started, today it would be worth 1.3 million Rand. Okay? Yes, it's one of the extreme examples. This doesn't happen every day. I want to make it very clear. but this is what happened to this company. Okay. And African Bank on the other side here, another bank. 10 years later, today it's only worth 17,228, and this slide was made about 3 weeks ago. I think African Bank is still going down, so it might be worth even less. For you to select shares, if you wanted to actually go and try and open an account and choose on how to select a share, you can use one of two methods. You can use fundamental analysis or technical analysis. These are the two main methods people use. You can use both. You don't have to use one or the other. You can use both. But fundamental analysis is where you're looking at the balance sheets, the financial statements of the company. If you enjoy accounting, you can actually go and look into the financial statements and actually see, are they making a profit? Is there value in the company? Is the share price undervalued? And you can then go and invest in that company after comparing it with other companies within the same sector. On the other side, you can use technical analysis, where you can go and look at the charts and the graphs, and you can see how well the company's in price has done in the past, in the history, and you can use a lot of different techniques and indicators that would give you an idea as to which direction it should be going. There's no guarantee, but those are the two different types that you can use. And I'd like to point out that with technical analysis, you can use what we call software. Okay? Now, I need to talk about the software a little bit. Is that a lot of people have been approached by people saying, listen, you have to have the software to invest on the stock market. You do not need technical analysis software to invest on the stock market. You can open an account with a broker. You don't need to use the technical analysis software. They can help you select the share. They can buy the share for you, and you don't have to worry about how to actually analyze it. Unless you are really computer literate and you love computers and you really want to do it, well, then you can go and look at using software packages, but you don't have to. And unfortunately, out there in the market, there are a lot of agents going around saying, this is the way you can invest in the stock market, this is the only way, or if you want to invest directly with the JSE, buy the software. And that's very incorrect. Okay? I need to point it out. And the reason I'm telling you this is that we get every single day calls coming to us in my department about the software, about people selling the software, saying they're from the JSE when they're not. Okay? So I need to make it very clear. You don't need software to invest in the JSE. It's only if you really like it and you would like to actually use technical analysis. But you can take the prices and even make the charts like I've done. All my charts here is in Excel. If you've got Excel, get the price history, put it in Excel, and you actually made these charts. You can get a free 30-day simulator where you can go and practice if you wanted to practice buying and selling. The JSE's got it. You just go to that web link at the bottom there, and you can actually have a 30-day trial. Soon we'll be doing a game. In the next coming weeks, we're going to be announcing a game. If you put your particulars in our feedback form, we will send you an invite to actually participate in a game where there's some prize money to be won, where you'll buy and sell shares, be given like R1 million, and you'll buy and sell shares, and the person that's got the highest return after, I think it's 3 months, will then win first, second, and third prizes. This is just a game that we will be playing at the JSE. If you would like to watch future webinars, like some of the folk that are actually watching today, you can watch this with your investment clubs. We're going to be doing a number of them this year where you can actually sit as a group. If you wanted to meet and actually watch this webinar, you can watch it live from anywhere in South Africa. Okay? And this is a live recording. All you need is a PC with an internet connection. And if you're going to watch it with others, you'd maybe want to use your data projector to project it onto the wall or something. But you can watch this from home. You can ask questions. The guys will be asking us questions at the end if they want. And this is what you need to do. Some investing education material. You can look at a lot of magazines if you're interested. You can look at some websites and some of the books you can go and read. There's so much out there for you to try and actually learn. And so these are just some examples that you can go and do. This is the steps to get started. If you want to get started, you can go and paper trade or practice. You can use the virtual trading game platform if you wanted to practice. For those that are still at varsity or have sons and daughters at varsity, there's a university game as well as a school game that the JSE runs. You can actually go look at the website, university.jsc.co.za, or there's another one for the schools. Any kids that want to play in a game, schools.jsc.co.za. But once you've practiced and you want to get started, you need to decide you want to buy shares, exchange traded funds, and then you can fill in give them the broker your FICA documents and actually start trading. An important point at the bottom here, I always say, you need to have some kind of plan. Especially if you're a group, you need to have a plan and you need to know what is my strategy. You can't just go and say, today I'm buying this and tomorrow I'm buying that. You're gonna land yourself in trouble because the share might go in the wrong direction if you're just guessing. You need to do some homework or ask the broker to actually help you. Are there any questions that you have for me? I think I'm going to hand over to Mark for him to get started. We're going to be here afterwards and we're going to take questions afterwards. So let me get Mark to get started, and thank you so much for listening to the presentation.
Thank you very much. Sure. Hi everyone, I'm Mark Wheatman. Welcome. Welcome to the guys online. This is quite new for me. I haven't talked in a virtual environment before, so to the guys who are logged on, hi. So I've been asked to talk about how, as a collective or a stockbroker or an investment club, however you want to call it, how you can come together and invest in the stock market. Now this is kind of new for me because normally I talk to individual investors, and that I'm used to. You come and you open an account with a stockbroker, we give you an online trading account, you come for training, you meet one of my traders, kind of easy. When you deal with a collective, it's a bit different because we're not dealing with one person, we're dealing with 20, 30, 40 of you or more. So what I was quite excited about though was, from a stockbroking point of view, the worst thing we like, what we don't like in life, is lots of tiny little accounts, because those are very, very expensive for us and takes up a huge amount of time. But one interesting thing is when you put all those tiny little accounts together in a Stokvel, they become one big account. And that becomes very interesting for a stockbroker, because suddenly you're quite important in his life, because you're putting 20, 30,000 Rand away every month as a collective, and at the end of the year, you might be worth R500,000 Rand. Well, suddenly you become very, very interesting to a stockbroker. So the message I say to all of you guys that are investment clubs, Stokvels, etc., is you are important. You must make your stockbroker treat you as though you're help me out here. Someone say that for me. In Kalakata. And I should be playing the music, actually. So my presentation was called Whale Investing, and a whale is a person who goes to a casino and is a big high roller. But I was told I needed to use a more local version of this. So just remember, as the collective, as the Stokvel, if you're all putting money in each month, you can become very, very important in your stockbroker's life. So into my presentation. So clearly you're here because you're interested in the stock markets. And what do they always tell you? And I hear this all the time. Build it up at the bank. You're too small. Put it into money market, put it into a banking account, come back later on. The markets are risky. Well, the markets are risky, but there are ways of managing that risk. It's not suitable. Now, there's a whole lot of regulation about treat client fairly and about suitability. You need to understand, is a stockbroking account really suitable for you? It probably is. It is a place where you can grow your wealth, but you need to understand the risk. You're too small. On your own, if you're putting 500 Rand in a month, you are too small. You aren't really going to make money in the markets. But if you and your colleagues are collecting your money together, putting it into an investment club or a Stokvel, you're no longer too small in the stockbroker's life. You don't know enough. This one I hear a lot. It's about education and training. We run between 2 to 3 courses a week to retail clients, educating them on how to trade the market. So there's a lot, and there's huge amounts of material online, some of it from the JSE, which will help you in terms of upskilling and training yourself. So there's never you're not clever enough or you don't know enough. You can always bring your skill level up in these markets. It sounds complicated. It's not complicated. You buy something low, hopefully, and you sell it higher. The stock market is not particularly complicated. People overcomplicate it because they probably want to sell you training, sell you technical analysis packages, etc. The market is not actually that complex. And you can always pick up the phone or go online on Skype and chat to a trader, and he will talk you through the share, how to trade, etc. And the last one I want to put to bed, shares are only for the rich. There's a problem in South Africa that there are not enough retail accounts on the JSE. There's probably between 200,000 and 300,000 accounts open at the JSE, and there should be about 1 million. Now, I think the problem with that is everyone perceives that the JSE is only for the rich and the wealthy. So clearly, these sort of events are here to prove to you that every retail client can get involved in the markets. It's not only for the affluent. So here's what I think. And this is a slide that I put together in 2002, and I still believe it. So 12 years later, it's the same slide. It also makes me lazy because I can reuse slides. But I still believe this. The stock market is without a doubt the greatest tool ever for building wealth. And I think Ralph did my job for me because he showed you all those wonderful charts of all those stocks, the Nasperses, of the world, the ShopRites, etc., how well they've done. And that is where you create wealth. You buy those stocks, you hold them 10, 20 years, they repay you massively. The second statement that I firmly believe in, this used to be a boys' club. This used to be a couple of people in a little market on the trading floor, jostling for position. The market's got electronic. Went electronic about 15 years ago. Now everybody who's got an internet connection or a telephone, mobile phone, whatever, can get involved in the stock market. So it's no longer that boys' club where they used to just jostle each other for position on a trading floor. So nearly anybody, and I would say that this is no longer so nearly anybody can buy shares nowadays. And with things like ETFs having come to the market, now everybody can own a share on the market. So, and it's not just me who thinks this. And I hate quoting my competitors, but Brett Duncan's a good friend of mine, and so is Brett McLaren. Brett Duncan is the head of retail equities at Standard Bank. And you know what these guys are saying, and Brett McLaren's at Saxo Capital Markets, basically what my two colleagues are saying is the same as me. Nowadays, with social media, the internet, you can get access to wonderful stuff. So the question that was asked earlier about fundamental analysis, you can go onto ShareNet, you can go onto MoneyWeb, you can go onto any of these, Profile Media. These guys have fundamental analysis for you. You probably don't have to pay for it. Put in the share code. If you go onto the NASDAQ and you type in a share code, you can get all broker research on the NASDAQ website for the US stocks. And the same is starting to happen here. So these things you no longer have to pay for this. This is free stuff that's out there in the internet. The other thing that's changing trading as we know it is social media. The fact that on the internet, you can go and find people like you who are discussing shares, getting together, whether it's via Skype, whether it's chat forums, etc., social media, Twitter. If you go onto Twitter on any given day, on our Vunani Twitter, you'll see us stock picking every day. If you come onto Skype and you join our Skype chat, you can talk to our stockbrokers in real time on Skype. So it takes a little bit of technology, but you can do this from your mobile phone. So what Brady and Richie are saying there, and I agree with both of these guys, sorry, it's Brett and Brett from Standard Bank and Saxo, is all of these wonderful things are now available to you guys. So you can actually do now on the stock market what a stockbroker used to do about 10 years ago, and he could only do it himself. You can actually replicate. So how do you get involved? So Ralph was talking mainly about equities. I just want to cover the other asset classes. So nowadays, your stockbroker is not just selling you shares or trading shares for you. But via ETFs, he can do a lot of things. He can do bonds. Bonds give you income. You need them. They're going to give you some yield in your portfolio. They also protect you when there's a sell-off on the equity markets. Property. Listed property, last 3-4 years, had a phenomenal run. Not a great place to be at the moment, with the interest rate cycle changing, but property is inversely correlated or negatively correlated typically with equities. So you want to put it in your portfolio and it gives you that diversification. But I'll come back to that a little bit in a moment. Equities, nowadays you can do local equities, and because of the ETFs that are linked to offshore shares, You can go offshore as well, but staying in rands. The thing is, when you look at your asset classes, you need to say, what is your time horizon? If you're only in there for 3 months, well, then you really should be in cash. If you've got to pay school fees in 3 months from now, you can't really go and buy shares because they could go down in the next 3 months. And you could get out less than you put in. What is your risk appetite? If you don't like risk, now, I must tell you that I've been trading now for almost 20 years, and I like risk. I love it. I come in every morning and I'll trade, and I like to take on massive amounts of risk. But I might not be you. You might be very, very conservative. You might want to have a balanced portfolio. You might prefer to have something that's very, very stable. So adjust what you buy in the stock market to your risk appetite. And then also answer the question, what sort of income do you need from this? If this is an investment that you're putting and you know that you need a certain amount of income, then you need to look for shares that have dividends, that pay dividends. You can't go into a mining company that never pays dividend, or a startup company that's very capital hungry and doesn't pay anything out, and it just needs more cash, if you need income out of your portfolio. So construct your portfolio to meet your needs. Ralph talked about this, and my slide will agree with his. The JSE goes up. The equity markets go up. There's no doubt about that. They do go down for short periods of time. But on average, the equity markets will give you between 15 and 18% per year on average. And the average is averages lie, because some years they go down 48%. So there's sometimes when you're going to take a lot of pain in the equity markets when there's a sell-off. But if you stay in there long enough, so you can see there's probably a little blip there for the big sell-off in 2008, 2009, and the market recovers that fairly quickly, within a year and a half. So you must be able to stay in the market and ride through that cycle. So equity markets will give you 15 to 18%. Bonds will give you less. I've got commodities in there, which is another play on the JSE. You can buy commodity-based ETNs and ETFs. So I've got the commodity line in there, and the lowest one there. What you've always got to be beating is in my slide there is that bottom blue line, which is inflation. If the portfolio of all the other lines that are on my chart there, if it doesn't beat that bottom blue line, you're going backwards. Inflation is taking away your money. So what you need to be doing is building a portfolio that always beats the blue line, preferably beats it by 3, 4, 5%. And that's how you should be constructing your portfolio. And I'll touch on that a little bit more in a minute. So the challenge for us with with clients that come to a stockbroker but are stokvels is the fact that there are lots and lots of little accounts, potentially. But if you put them all together, then we see one account. Now, the problem with that is, when I report to you as a stokvel, you know, Mr. A, who is part of the stokvel, so let me get this working here. And sorry for the guys in the virtual world, you won't be able to see my little pointer, but it's on the right-hand side of my slide there. You can see what you typically want to do is you get an administrator that can report to each stokvel member. So let's start on the left. The stokvel comes along to the stockbroker, opens up one account. And we'll talk about that a little bit more in a minute. They open up one account with the stockbroker. They typically, the treasurer, the chairman, the secretary, all signs the documentation. You put some money in. You carry on putting money in every month. And that's fine. You have this one account, and we construct that account for you. And I'll talk about constructing that account in a moment, what we put in that. The problem is it's one account. So Mr. A, who sits over there, doesn't actually know how much he's worth in that account. So what we've done is we've built a product where we take the stockbroking account and we report it via administrators, being iTransact. Now, iTransact are the guys that make ETFs work. And we'll come to that ETF question that was earlier. These are one of the administrators. So they sit behind a company called ETF SA. So they're an administrator that makes exchange-traded funds work. These guys can then report to each individual in the stokvel or the investment club exactly what you own and exactly how much you're worth every month. So the whole system is exceptionally transparent. So as a stokvel member, if your treasurer comes to you and says, hi, you're worth $1,000, and you log in online, you see you're worth 500, well, clearly someone's had a big lunch somewhere along the line. So does that make sense to everybody? So what I'm trying to, in this slide, show you is that you can open a stockbroking account and then break it out for all your members. So this is particularly aimed at the sort of Stokvel investment club type business. Why this is important for us as a stockbroker is we don't really want all these little accounts that are opened with us. We want you to come as a club and have one account. And you want to be one account as well, and I'll come back to that in a minute. So we decided for today that we would apply our minds and come up with two products that we could offer to the sort of investment club Stokvel market. And you can do this as an individual as well, but we've aimed specifically at Stokvels. And what we've called them is, and what I liked about Ralph's slides, and it shows you that people think the same, is we've called this our AMA 10-10, which means we're going to try to create 10% return by our basket of shares for 10 years. And all of Ralph's slides were 10 years. So that makes me feel kind of good that we're on the same wavelength. And I think the reason why 10 years is a good time period is because you need to be in the stock market sort of 5 to 10 years, minimum 3 years. If you're going 1 year, you could catch one of those sell-offs and you could halve your money. So on the left here is what we call our AMA 10-10, and I'll drill into this in a minute. But this is that sort of portfolio that we take ETFs, exchange-traded funds, and we build you a portfolio, a model portfolio. And our aim there, we haven't made it too risky. We've made it middle of the road, medium risk, and we've made it inflation plus 4. So that's about 10%. And we're saying we're going to go and pick you, or you can work with us if you really want to, but we're going to pick you what we think is a diversified, the best ETF portfolio that we can as a stockbroker. The other side of it is if you're what we call our big boss portfolio, is if you are a big Stokvel, well, we can sit there and we can help you choose from the 300-400 shares that are listed on the exchange to build a portfolio of shares that will, I'll show you some performance in a moment, but Ralph has also shown you, will do exceptionally well in the market. But this is kind of aimed for bigger investment clubs, bigger Stokvels, because you can't really get a diversified portfolio of shares if you've only got 1,000 Rand. You really need to start putting in 15, 20, 30,000 a month as a big Stokvel, because then you can build yourself up to 3, 4, 500,000 over a period of time, and you will get a very, very diversified, big, wonderful portfolio with that. So on the left, aimed more at smaller Stokvels, smaller investors who don't mind a passive type portfolio. On the right, very much more active stock picking. One thing I must say about both of these accounts, if you open up either of those two accounts with your stockbroker, you are still going to get a stockbroker. You can phone him. You can ask him for research. You can come to the training. You can log into the online platforms. We don't differentiate between those two accounts. All of our clients get that same sort of research, training, online access. So an example of some of the research and the training that we do, every Tuesday at 12 o'clock, we run a webinar and we trade commodities. Now, that's probably not appropriate or interesting to a lot of you, but it might be. If you wanted to find out how to trade gold, platinum, silver, copper, wheat, corn, every 12 o'clock, every Tuesday, online for an hour and a half, people can log in, they can watch us trade. And we trade in real time with real money. And sometimes we make money and sometimes we don't. And that's the sort of stuff you should start expecting your stockbroker to start doing for you, so it brings up your skill levels. So these are our two portfolios. So let's drill into these little portfolios a little bit more. And I'm sorry, this is a very busy slide. So let's take it from the top, what we're trying to achieve here. We're trying to build a portfolio mainly in equity. So it's about 60% will have shares in this portfolio. All of these things exist on the JSE. Everything I'm going to show you in this portfolio exists on the JSE and you can trade it. So we've benchmarked ourselves against the unit trust, multi-asset, medium equity. All that means is it's got multiple assets, it's got bonds, cash, property, equities, not just shares. Medium equity just means it doesn't have a lot of equity, it doesn't have a little amount of equities. It's got about between 40 and 60% shares in the portfolio. It's got an average risk. This is for Joe average, right in the middle of the risk spectrum. And we can make it more risky, we can make it less risky. It aims for capital growth. As I say, it's got a 60% equity exposure, and that includes international shares that are listed locally. And we're constrained to only going 25% in listed property. That's property that's listed on the JSE and traded. So how does these sort of portfolios do over time? And I remember we're trying to make sure we always beat 10% per year. So these are the average performance, and what I've done to show you that this works, these are real portfolios, and this is based on all the unit trusts that are in the medium equity. So this means that you can build something that's exactly the same as a unit trust manager has, and you don't have to pay him for it. So over 1 year, market's been very kind, 15.6%, 2 years, 14.98, that's 14.98 per year, not over 2 years, 14.98 every year. Out to 10 years, over 10 years, we've averaged, I think it's 12.74. The top line, the top green line there is the best unit trust, and the bottom red line is the worst unit trust. So clearly, if you gave your money to someone else to manage, a unit trust manager, you're sitting somewhere between the top line, which is the green one, and the worst guy, which is the red one. Clearly, you don't want to be with the guys in the red one. The gray line is the average. So if you were just average, and nobody wants to be average, but if you were just average, you would have got well above that sort of 10% by just constructing a portfolio like this, per year, every year for 10 years. So what does that sort of portfolio look like? Well, it's got a big chunk of equities. And we'll talk about what equities now. But it's got about 37.5% at the moment. We have 37.5% in local JSE shares. We have another 20% in foreign shares, but are traded on the JSE. So that's 57.5%. So we're below that 60% threshold. So at the moment, our mindset is that this market is expensive, but this market can carry on going. So we're very close to being at that 60% still. And as this market gets more and more expensive and people start talking about a big sell-off and a crash, etc., we will start reducing that equity exposure, but we probably won't go below 40% because we want to stay between 40 and 60%. Then there's some other buckets that we throw in there. You've got a bonds component. That means bonds that are on the JSE. Listed property. So these are all those property stocks that owns office blocks. I see you taking a photo. This is on the webinar. So the webinar, just for everybody, this webinar is recorded and you can download it after the seminar. And I'm very happy to send you more details on this portfolio if you want as well. Okay, we can drill into this portfolio in more detail as well if you want to ask questions. And the last chunk is you always need a bit of cash in a portfolio. You need some liquidity. So I seem to be favoring the guys on this side, so I'll start looking this way now. So how do we do that? Now, we've made this one quite simple. We've just taken a whole lot of ETFs. So the exchange-traded funds that Ralph was chatting about earlier, and we've slapped in, and I suppose the question that was asked about the costs of administration on ETFs is quite important here. If you're just going to buy an ETF and it's the top 40, buy the cheapest one. And there's probably about 6 or 8 ETF managers that have top 40 as their mandate. Buy the guy who's got the lowest tracking error. That means he always stays and he matches the top 40, and buy the cheapest one. So if someone is charging you 40 or 50 basis points, 0.5%, to manage a top 40 ETF, and another guy is charging you 19, and that is about the range at the moment. I think it might be 18 or 19. Buy the guy who's cheapest because they're both giving you the same thing. Because there's this thing called total expense ratio that they have to because they're a unit trust. Remember, an exchange-traded fund is a unit trust that's traded on the JSE. But in terms of the collective investment scheme, they have to tell you the costs. They can't hide the costs. So they have this thing, and they might make it very small, but it's called TER. And you just go and look at the TER, and if those fund managers are doing exactly the same thing, and they're just a passive fund, buy the cheapest. So hopefully that answered your question about administration, because that TER has to include all costs. Okay, so that'll be his audit costs, his custodian costs, everything has to be in that cost. The only cost that won't be in there is brokerage when you buy and sell that ETF. So there, go to the guy who's going to give you the best deal as well when you buy that ETF. So just having a look at this basket, and you can replicate this basket yourself. The first one is cash. Next one is bonds. In bonds, you typically get two different, you get ones that either track the actual bonds, the government bonds, or you get the inflation-linked ones. At the moment, we've gone for the inflation-linked. We've used the Grindrod prop tracks, and we've used the Stanlib SA property. Those give us a big chunk of listed properties, and you can see that's making up, it's about 20% of the portfolio. Then we've bought the world for the other 20% of our equities. We like Europe, so we've got Europe in there. We've got a little bit of US. In fact, we've got a lot of US. It's just hidden. Inside the DBX Tracker world, about 50% of that is US stocks. So that component there, the 20%, that gives you that nice offshore exposure so that you're not just reliant on the local exchange. And then the rest is us having a look at which of the ETFs we think with the equity basket we're willing to be in at the moment. We like mid-cap. We have the #1 rated small cap analyst in the industrial space. His name's Anthony Clark. You can get his research on our website. And because we have the #1 rated small cap analyst, we tend to like small cap and mid cap shares. It's what we're good at. So we tend to have mid cap in our portfolios. And you saw earlier in Ralph's presentation, mid cap shares can reward you. They can do very, very well for you. So we have 7.5% of our portfolio in mid caps at the moment. The rest in ERAFI and another one called low volatility. We are not just buying top 40 at the moment because we think the top 40, the actual top 40 itself is very dependent on what happens to resources stocks and what happens to the rand. And if you can tell me what commodity or resource stocks and the rand are going to do at the moment, you can come and work for me because we can't get it right at the moment. So we tend to avoid trying to place that bet. Because for 3 months it looks great, and then for the next 3 months it looks awful in some of those resource stocks. Okay, so just to run you through an example, and this is my colleague Apandilo who's at the back, put this example together for me. So we have the Stokvel out of Soweto. It's got 20 members, and they each contribute, let's say, 1,000 Rand per month for 10 years. Effectively, and this is the problem with Stokvels, unfortunately, is there tends to be, although there's 800,000 odd Stokvels, they tend to be rotational in nature. Money goes in and money comes out. It doesn't stay in enough. So even the investment in saving Stokvels, the money's not sticky. Everyone takes it out over Christmas, or they need it for whatever event it is. So I've assumed that this is a Stokvel that's there for the purposes of investing in your future, and you're going to stay in it. So in terms of this, I'm a 10-10. We're trying to make you 10% for 10 years, which you've seen is quite possible. It's quite reasonable to do that. You will have actually, as a membership of 20 members, each putting in 1,000 Rand, have contributed over 10 years 2.4 million Rand. That's a massive amount of money. And the problem is Stokvels don't get there because everyone keeps taking the money out. If you are then doing 10%, which is inflation plus 4, so there's your capital. There's this wonderful thing called compounding. Every year you get growth on growth on growth if you leave your money there. And that's why this curve actually is not a straight line. It goes up. And the longer you leave it, the more it goes up. So you would actually be worth 4.1 million on your 2.4 after 10 years. And that is why you should leave your money in the markets for a long period of time. Because you make a substantial amount of money. It's 1.7 million. And this is why my whole message I would like to leave you with is you will never get these returns by leaving it in the bank as a Stokvel account at 2%. You're just not going to get there. 2, 3, 4%. And we've done this return with medium risk, and we've beaten inflation. And that's the important thing. And that portfolio is very easy for you to replicate, guys. And if you have any problem replicating that, got my guys, you can phone them. They can take you through this sort of. So now let's get to the more complex one. So this is now assuming that you're going to go and pick shares. And I'm going to use these. These are real portfolios that we run. And I just wanted to show you how we think as investors, and that if you're going to be a Stokvel that buys individual shares, you should think like this. So we run a couple of different portfolios. We run our accelerated, which is our highest risk profile. So when we were talking about the other one was CPI plus 4, this one's sort of CPI plus 9. Should be getting 13, 15% per year In fact, you should be getting 15% plus per year because you're taking on quite a bit of risk. Then income and growth. This is a portfolio where we've gone and picked stocks that have more dividends, less risk. And then we run what we call our emerging companies. That's our small cap portfolio. And that has done exceptionally well, 111% over the last 2.5 years. And that's by picking good little stocks. And as I say, Anthony Clark, who is our #1 rated small cap analyst, he tweets every day. Twitter's a wonderful thing. You can get on your phone. He tweets every day when he goes and sees a manager and comes out and says, "Hi, I've just been to Cura. I think it's fantastic. These guys are doing wonderful things. I think you should own their share." I mean, that's a wonderful thing, and you're getting it for free. So if you go onto our website and you go and look under our Twitter feed, you get those sort of trading ideas from us every day via our own trading desk and our research analyst like Anthony Clark. So just to show you, that's the top 40. So, I mean, it's done damn well. There's nothing wrong with that. Ralph has shown you the top 40 has done exceptionally well. But what you want to do is actually build yourself a portfolio that actually beats it. And you can see that's our portfolio. That's our emerging small cap portfolios. They have done exceptionally well. When you pick good stocks, and you have to have rules around it because, guys, we've all been there. Pinnacle Technologies in the last couple of months has just been decimated. It got to sort of mid-20s and is now sitting at about $11. Now that's in our small cap portfolio. So our emerging companies portfolio has made 111% despite the fact that one of the shares that we own is halved. And the reason we haven't taken a big hit on that is because it's only 4% of our portfolio. It's now no longer 4% of our portfolio because it's halved, so it's about 2% of our portfolio. But it doesn't really hurt us. It makes our performance look quite bad on that share, but in terms of a portfolio of shares, you know, we don't get hurt. So the one thing I would encourage you when you build portfolios like this yourselves, try to put 15, 18, 20 shares in your portfolio to diversify your risk. Because if you have a portfolio that only has one share in it and it delists, you are now worth nothing. So be careful. Spread your, don't put all your eggs in one basket, as they always say. Spread your risk around. So to kind of give you some ideas, I'm not going to give you all our trade secrets, but I'm going to give you what our top 5 holdings are in each of those portfolios. And actually, if you phone one of our traders, they'll tell you what the other 16 or 18 shares are, I'm sure. But this is Naspers. You've got to love Naspers. Very expensive, but the thing keeps going up. And we have a philosophy. You don't sell Naspers. You stay with it as long as it keeps giving you good growth. You stay with it. One day this stock will run out of steam. And that's where we were talking about that greed question earlier on. You stay with it, you stay with it, you stay with it, but you stay with it with a stop loss. And when it comes down and hits your stop loss, your trailing stop, get out. Omnia. Who would have known that a little fertilizer and chemical company can make you so much money? Mediclinic and Aspen, also 2 good stocks. Aspen up and down a little bit. But we have on our trading desk, we also don't sell Aspen. We always only buy Aspen. So, and MTN. Good stocks. All quite expensive. The whole market's quite expensive in those sort of areas. But stick with them, and if they start coming down, get rid of them, find other ones. Income and growth, and you'll see that there's some overlap between these portfolios, clearly, because we use the similar research. Naspers finds its way into our income and growth because it's a good stock with dividends. MTN, good stock with dividends. So it's in our income and growth portfolio as well. Bidvest, good industrial stock with dividends. So in our income and growth, we tend to look for stocks that give us an extra 1%, only 1% extra dividend or extra yield per annum is in the middle bucket. And then the emerging ones is where you can have a bit of fun because these are penny stocks and some of these penny stocks will kill you. I mean, they will. Unfortunately, that's the nature of penny stocks. Because the slide that Ralph didn't show you is how many shares are no longer on the market. How many shares listed in the late 1990s and are no longer here. A company, there was an ice cream company called Milkworks. I think it lasted 2 years, disappeared. There's stocks like that that do come on into the small cap space. You've got to do your homework. Make sure you're buying it. Even on small cap stocks, you must do your homework. Make sure you're buying a decent share. companies like Tor, Mediclinic, Coronation, these sort of stocks, not necessarily small caps anymore, small to mid cap sort of companies. Very nice portfolio. And then what I've just done is I've added in at the bottom there the sectoral weightings, because these things are in different sectors. But certainly, I would encourage you to look at any of those top fives, and you can build a portfolio out of those. You wouldn't have a problem. So I'm getting near to the end of my time. So whether you come to Vunani or you go to any other stockbroker, and there's a whole list of them in this handout, there's a couple of things that you should be looking for as an investor in this market. Research. You should get research. Get a morning note. Get stock tips. Get analysis on companies. You should be asking your stockbroker from that. They should be able to supply you reasonably good research. Cost. Markets become very cheap in terms of trading. If you're paying 100 basis points, 1% to trade, maybe even 70, 80 basis points to trade, it's probably too much. You know, the price has come down of trading. Most retail brokers will be around about 50 basis points, 0.5% on trading at the moment. You know, and that's not a reasonable price. The broker, you know, we need to eat as well, you know, because we do all these other wonderful things for you. So like trading and education, whether it's online trading and education, coming to a webinar or coming to the JSE or going to their offices, they should be doing something for you. And as I said, next Tuesday we've got commodities. On the 17th we've got the 80 trades here. We have a Forex seminar coming up. We have a technical analysis seminar coming up. So those are free. Your broker shouldn't be charging you for those. You should be able to get those free out of your stockbroker. And the thing about, as a Stokvel, if you get big enough, you should be able to phone your broker and say, hi, can you come next week or 2 weeks' time, give him a bit more notice, and do a presentation? We want to know what's happening with the rand. We want to know what's happening with gold. We want to know what's happening with the oil price. You can ask him. He will come and do a presentation for you. If you are 20, 30 investors and you're worth $500,000 account with him, he will definitely come and do a presentation, and he will buy the drinks. So, and if you don't ask those questions, you will never get in life. That's my biggest, I've always say, you don't ask, you don't get. So as a Stokvel, you should be asking those questions to say, hi, we have an account of R1 million with you. What's our brokerage rate? And if he's charging you 1%, oh, threaten to move your account. You know, you can negotiate your cost down. He should be giving you online access to trading platforms. If you're a R1 million account and you're trading quite actively because you're a Stokvel, you should be getting the trading account for the trading software for free. So that brings me, I suppose, to technical fundamental analysis. Those are available from your broker. Ask him for them. Most stockbrokers nowadays have their own technical analysis software or have outsourced it. So it is available to you. Trading front ends. We run about 4 or 5 different trading front ends that you can use, from very basic stuff that's on your phone and on your tablet through to very, very complex stuff that you can put algorithms and automated trading, etc., which is probably an overkill for most people here. But have a look at the trading front ends, and you can run them on your phone and your tablet nowadays. And then access to portfolio managers and traders. Now, understand that a trader has a telephone, and that's his lifeline. So if you sit on there for an hour with him, he can't speak to other clients. So, you know, phone your broker, have a chat, but keep it short, keep it sweet. Ask him what's going on in the market, or preferably go on Skype and ask him, because then he can chat to you at his leisure. And we have a Skype forum. Anybody in this room, I welcome you. You can join our Skype forum. You just need to go onto our website, click Skype chat, and you can chat to any of our traders. And between trading hours of 8 in the morning, maybe 7:30 till 6 at night, there will be our traders on the other side of that. And you can ask them. So if you're in a share that's going horribly wrong, so if you're in Able and it's suddenly becoming a mess, and you need to ask a broker, and you really just go onto Skype and ask us. I mean, that is the sort of availability that you should now get from both your trader, your portfolio manager. If there's someone helping you manage that portfolio, you want access to him. You don't want his fund fact sheets every quarter. You want to speak to him, and your financial planner. And I must say, the only way you're going to get this right is really by using your Stokvel and using the clout of putting all your money together. So just in terms of that, I'm not going to labor this too much. We can make this available to you guys. But if you've got a Stokvel, most stockbrokers will accept your constitution document. as long as it has things in there like that we can measure. So what is your objective? It's to invest in what? On the JSE, hopefully. You know, membership requirements. If your thing says it's capped at 50 members and you've got 100, well, you know, we will have a problem with that because we've got to administer that. So as long as you've got a reasonable constitution, we may give you a document that as an addendum where you get your guys to sign which says we want to open an account on the JSE and this is how we want to manage it, etc. We may ask you to just addend that to your constitution. We need someone who's authorized. We can't ask every member of the Stokvel or the investment club to sign every time. So you will at a point in time have to sign an authorization document authorizing the members of the Stokvel to open the account. Wow. Asking the chairman, the treasurer, the secretary, all three or one of them to open the account. We will FICA. FICA, death taxes and FICA. You can't get away from FICA. Whether you call it FICA or RICA on the cell phone side, you cannot get away from FICA. But typically your stockbroker should only FICA the chairman, the secretary, and the treasurer. They don't need to drill down. Okay. Member register, we need to know who you other guys are. You know, because when you want some money out and, you know, we want to report to you as well on the systems. We want to give you a login as the member of the investment club. And then the key thing is we're not a bank. Stockbrokers are not banks. So you can't walk up to us and give us 5 grand worth of cash. In fact, we're not allowed to accept it. You know, we're not allowed to accept any amount greater than 25,000 in cash. We just cannot. We're not a bank. So typically you need to have a bank account and we will go and fetch the money from that bank account. Okay. Anyway, that's about it from my side. I hope I've managed to cover the topic. I'm very happy to take questions, and I'm sure Ralph will help me with the questions.